Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome back to the Risk Intel podcast. I'm excited to have Shawn Ryan rejoin me today to pick up our conversation about third-party guidance and third-party risk management. Shawn, thanks for returning to the show.
Thanks for asking me back, Ed. Glad to be here.
Shawn, as we've talked about before, right, you've worn a few different hats, right? You've sat inside a community bank yourself. You've sat inside a large financial institution. And now one of the hats which you wear inside a RegTech is that of the chief risk officer. We in our last conversation, we began to unpack the third-party guidance that was a guidebook that was released in May of this year. And we talked about two of the themes in there around planning and termination.
That's right.
And so I'd like to pick up on this conversation and unpack the other three pieces of guidance around due diligence, contracting, and monitoring. And then I'd also like to go perhaps a step deeper into your practical experience of this inside of RegTech and wearing that risk officer hat. So let's start by going back to the guidebook there, right? That came out, and these three areas of due diligence, contracting, and monitoring, and your observations on the feedback there from the regulators.
Yeah, so I don't think that the regulators are looking to help the financial institutions focus on these activities with greater detail, with more deliberation than they do for other third parties. So the point is that when you work with a financial technology firm or a highly risky critical activity, somebody who's responsible for a highly risky critical activity, that you got to do a little bit more than you might normally do in your normal procurement routine. And I think that obviously we talked about how that begins in the planning cycle, but where really the rubber starts to meet the road is due diligence. And so you currently, my recommendation would be if you currently delegate due diligence of third-party vendors to a procurement function or to a specialist within your organization. If you're going to do this with a FinTech or a RegTech, you ought to bring that closer to the business line, so closer to the person who's on the front line who might be working with that relationship every day, because there's a couple things that are going to happen. First of all, oftentimes, these are less mature organizations than you're used to working with, right? This is not a core service provider. These are often startups. They are often venture or private equity funded. They may have, less employees than you typically work with when you work with a vendor. And so think about all those considerations when you begin due diligence, right? It might not be as fast to respond as an organization that has 500, 1,000, 10,000 people, right? At least in my instance, right? When due diligence, I think at SRA Watchtower, there's 2 or 3 people who handle due diligence, and 2 of those do it part-time. One of them does it roughly full-time. And so if there's a question that they get from a financial institution during due diligence, then they likely have to come find me and ask me that question, or come find you and ask you that question. That takes more time than it is if there's a standard set of questions that you go to a publicly traded company who's used to doing due diligence, being on the receiving end of a due diligence request all the time. The other thing that I would suggest is that you understand that, get back to the planning stage, when you plan to work with a less mature organization, you recognize that there are going to be some compromises during due diligence. You may not be able to get a SOC 2, for example. Not all financial technology or regulatory RegTech companies have completed a SOC 2 Type 2 or a SOC 2 Type 1. So it may be more difficult for them to provide the InfoSec due diligence than it is for a publicly traded company. They may, for a variety of reasons, not be able to produce an audited financial statement. They may not be allowed to release them by their covenants with their they're equity investors. They may not, there may be other reasons why they're not allowed to do that. So those are just two examples, right? Things that you may say, why can't this be supplied to me? That there may be a very good reason. I'm not saying you should stop everything and say, okay, well, I'm not going to get those things. How do you manage that risk then? Are you going to ask them to do some type of special financial reporting so that you can understand what their financial position is, so that you understand if there's a risk of them becoming insolvent? You can work around those things. That's where you build risk management controls into your relationship with them. You begin to understand what those controls might need to look like during the due diligence process. And of course, you want their policies and procedures and as much of that stuff as you can get. And you also want to communicate to them that, hey, we're regulated, we're a regulated entity, and the regulators are going to look to ensure that your risk management practices meet the regulations and laws associated with a financial institution.
Right. So there's an element there of awareness of the counterparty, the partner, and their capacity to handle these due diligence requests, their ability to produce the desired materials, and your responsibility as the financial institution to maybe be willing to be a bit more flexible with them, or understand what their constraints are, what they actually can accomplish. But if I go back to the one of the quotes that you included in your presentation at the Independent Bankers of Texas conference, and right, there's a quote in there that you pulled from the guide for community banks, and it said that, essentially, right, you as the institution are just as responsible as if the bank were to perform the service or activity itself. So, right, you need to figure out a way to be flexible, but ultimately you have to hold them to that same applicable legal and regulatory requirement and standard that you were being held to as a bank.
Yeah, we're a risk management organization. So the financial institutions that we do business with don't have to teach us about what federal banking regulation looks like, but 95% of the non-RegTech financial technology companies that the bank may choose to work with, they don't have a deep understanding of the federal regulatory landscape. They don't know what the Consumer Financial Protection Bureau is all about, and how this guidance makes particular focus on two aspects of the federal regulatory or legal landscape. One is consumer financial protection. Is the third party doing what is required with respect to protecting consumers? And the second is financial crimes. Is the partner going to maintain the kind of risk and controls that avoid financial crimes taking place within their platform? And so a lot of times when you work with a fintech as the financial institution, you're going to have to, particularly, and it's best to do it during the due diligence process, you're going to be doing some training, you're going to be doing some educating, you're going to be helping them understand what your risk management and regulatory expectations look like, and then help them build those into their process and their business environment when it's possible. Shame to say that this is what SRA Watchtower does. We help fintechs by having fintechs do a risk assessment. We help fintechs identify how they look through that enterprise risk management or regulatory risk management lens. And so the bank has to do that. The bank has to help the fintech or the regtech do that in many instances in these relationships, particularly for the most immature organizations that you might choose to work with. And if you listen to the previous podcast, I would never suggest that you shouldn't work with less mature organizations. I think that's where creativity and innovation and competitive differentiation is going to come from. But if you do so, you've got to establish good guardrails, and you can do that by doing thorough due diligence and understanding where those guardrails need to exist.
Yeah, and understanding the other thing you tied it back to in our last conversation was tying it back to that risk appetite statement and
Yeah,
understanding, right,
of course.
what is the risk tolerance level of the organization. So let's
Right.
continue on from due diligence into kind of this next phase, right? You've gone through this process, you've demonstrated some flexibility, but at other points you've had to stand your ground, right? But you've got to the point where you found an organization, an entity, a business that you're comfortable working with.
Yep.
But now you've got to, as you said, you got to put those guardrails, guideposts in place. Observations that you have from the contract negotiation phase of the life cycle?
Yeah, I mean, I think my first observation, at least sitting from this chair, is we're a software provider. These largely, when you think about the highly risky critical activities, the FinTech, the RegTech, it's often a software as a service or a managed service of some kind. And I promise you that entity, that partner that you're considering, has spent a lot of time developing a contract. So the most frustrating thing is when the institution comes back and has massive amounts of red lines in the contract. That's a burden on the FinTech, right? They don't have in-house legal counsel. They don't have they don't want, because of the way they run their business, they don't want contracts that are massively different from client to client to client. So the more you ask for red lines, the more you've made it difficult for them to become your partner. One, the time and cost it's going to have on them. They're already in the hole if they've got to go out and get an attorney to review your red lines, because they don't typically have in-house counsel. So I think you ought to advise your in-house counsel when you hand them their MSA that, look, what we're looking for are the deal breakers here. What we're looking for are the guardrails so that we can enforce our risk management and performance expectations. Some of the things that often we find sitting in my seat, right, when I get a contract with a client bank, right, jurisdiction. It's often the case that a community bank wants to place the jurisdiction of the legal agreement in their hometown, right? Oh, we're from Abilene, Texas, and we want the this to be the jurisdiction to be our home in Abilene, Texas. That seems highly unrealistic from the standpoint of the financial technology company. Maybe try to pick either a nationally recognized arbitration body to adjudicate disputes, or maybe I would say 80% of the companies in this country are domiciled in Delaware. Maybe
right.
Choose Delaware, right? That might be a solution. The other thing that we've seen, Ed, I know this, is reliability thresholds, right? How often is your product or service going to be up? The difference between 99.9 and 99.5, I think, is like a half a day or a day. Do you really need to go back and redline that piece of the agreement? Are you adhering to a standard that you have for your core provider for this particular, for this RegTech company? And is that a reasonable expectation for you to have for the service that this company is providing? Do you really need that reliability? Those are just two examples of places where I think we get hung up a lot in contract negotiations, in my opinion, potentially unnecessarily. The other thing that most fintechs would be looking for is some form of mutuality, right? If you're going to have a cancellation for convenience, then what are their opportunities to get out of the contract should the partnership not be working out the way that they anticipated that it would?
I think I would summarize that as trying to meet the partner, right, somewhere in the middle, or close to their starting point as possible, right?
It's easy, right? You're the institution. You're the 150-year-old bank. You're the person, you're the organization with a procurement department and an audit department and a legal counsel. And so yes, you you have all the leverage in this negotiation. Don't use that leverage so that you're the winner and they're the loser, or because that's gonna, then you started out, you might as well go run straight to termination. You're looking for, in every contract, you talking to a lot of business people, you're looking for a win-win. Don't put the fintech partner on their heels during contract negotiation. Again, don't allow risk to creep into your system. That's a consent order waiting to happen. I'm not suggesting that at all. Those are the things that you want to focus on. Do I have the mechanisms to control risk, to measure performance, to monitor performance, which goes on to the next stage in the life cycle, right? Build those things into the contract. That's where you want to spend your time negotiating, not where the jurisdiction is or what your, that the uptime is a 0.5% different than your policy document. Get a policy exception and let them have that 0.5%. Focus on, have I clearly articulated what good performance looks like? Have I clearly articulated what controls that need to be in place in order for me to measure and monitor risk? And then probably the one that I haven't mentioned yet is, escalation and resolution. Do you have those things clear? Which is more about ongoing monitoring, right? Do you have that built? Build that stuff into the contract, I think, is the most effective approach to take.
So let's come back. Let's pick up on that last stage of the life cycle of monitoring, right? And you talked about some of the things in there around good performance and escalation, and I think that begins with just the broader concept of having visibility into what's going on.
Yeah, I got a great John Wooden quote that I used here when I was at IBAT. Without proper evaluation, failure is inevitable. And for those of you who don't know John Wooden, he's a basketball coach who I think won 10 or 12 championships in a row during his tenure at UCLA. Yeah, we want the third party to have quality controls in place. We want those controls to be sustainable. As we said before in both sessions, the regulators expect you to instill your risk management practices and expectations on the fintech. So you have to have a way to monitor that those expectations are being met. You obviously want to be able to monitor performance, right? You're working with a depositor, someone who's going to gather new deposits for you. Whatever those expectations are, you want to be able to see that they're doing what you brought them on board to do. And then you want to make sure that they're doing it in the most well-controlled way, right? We talked about financial crime. So you want some mechanism to ensure that the deposits that they're gathering they're doing so in a consumer-friendly way, and they're doing so without violating any of our financial crimes laws and regulations. And then you want a mechanism, if you discover that that's not happening, right, to escalate,
right,
and then a mechanism to remediate. So those that monitor, escalate, remediate. You want to have that built into your process. You want to have, as I just said, to the extent that you can build that into the contract, that's the area that I would focus on. But you should lay out what that ongoing monitoring looks like at the get-go. You should establish the roles and responsibilities on both sides of the house, your side of the house, their side of the house. You should let them know up front if you're going to be sharing that information with the regulators, which I would suggest you should and will. All that stuff you should try to establish up front, and then and you want to basically outline a way to ensure that you can monitor this organization on an ongoing basis. If you want to have access to their if they do internal risk assessments, you want to have access to them. If you want to bring on somebody like SRA Watchtower who can implement a risk management solution that is regularly refreshed, either the bank can do that or the fintech can do that. You want to establish that there. And it's worth noting, because it's called out explicitly in the guidance, if you decide to outsource your risk management of a third-party relationship to someone like SRA Watchtower, you have not abdicated responsibility for good risk management practices. You've just placed that burden on the third party who's going to do it for you. They still must do it to your expectations, in line with regulatory guidance and laws and regulations. So yeah, ongoing monitoring is where the rubber meets the road, if you will. Is the relationship performing as expected? Is risk being managed as expected? If not, how do we fix it?
All right, you've taken us through these three steps of the journey of due diligence, contracting, and monitoring. A lot of great, I'll say, concepts for people to consider as they embark upon these steps, from flexibility and what really matters and the principles during due diligence, and tying it back to risk appetite statements and your organizational tolerance levels, through to that contracting stage of, are you trying to get to a win-win? Are you trying to get to a win-lose? Right? What really matters?
What's the goal? Yeah.
Right. What is the goal? Right? Where do you need those guardrails to be? And then finally, how do you monitor and then escalate or remediate, right, in that last phase, so you can avoid the inevitable failure there, as John Wooden noted, if you're not evaluating it properly.
Correct.
Any final observations, Shawn, that you have based upon the seat that you've been sitting in now for a little while, wearing the risk leader hat there inside of RegTech?
Yeah, well, just for the financial institutions to remember, the stage, the size, and the lack of complexity of the organizations they're working with, right? We are fortunate enough, Ed, to have relationships with a bunch of other fintechs and a bunch of other regtechs, and I would say 95% of them look like us, right? Not a large employee population, a good, healthy and growing, but not thousands of customers, right? Still in their early stage or the growth stage of their life cycle. This means that everything the institution that they're trying to work with asks them to do that is bespoke is a burden, is harder, is costlier, distracts them from delivering the performance that you're asking them to deliver, right? So that's what I would say to the financial institution. If you decide to embark on a strategy that you're going to do business with fintechs or regtechs or other technology-based organizations, have your eyes wide open when you go into that relationship with the type of organization you're working with, and try to tailor your risk management approach so that it's a win-win for both partners. Then you will bring innovation and creativity to your financial institution, and you will develop a strong relationship with your partner that will allow them to succeed alongside of you. And that's, I think, what we want out of these kinds of relationships. And it's, frankly, I believe, what the regulators want as well.
You're on the money there. I'm not going to try and say it any better, Shawn. Thank you for that recap there, right? Tailoring your risk management approach, right, to earn that win-win is ultimately what leads to the, and I'll steal a line from our friends at the American FinTech Council, right? That leads to responsible innovation, right? That is the objective here, right? And I think that you articulated a handful of really key principles and applications of the concepts in the regulatory guide there that came out in May of this year. So, Shawn, thank you very much for your thoughts, your perspectives, and your observations.
Thank you.